Over the last 12 months, it would be pretty hard to pick a stock that hasn't performed very well, but when we do take a look at the specifics of the beverage industry, we do note a lot of companies like PepsiCo, like Monster Corporation, have been performing very poorly. Even Coca-Cola up only single digit over the last 12 months. And when we do take a look at the market share of leading energy drinks, it isn't surprising to see a very well-known name, Monster Energy, in second place at 29.7%, although we do have to give an honorable mention to Celsius, which is 5.9%, and in fact have performed tremendously well over the last 12 months, up 33%, and over the last 5 years, this is a company that is up more than 4,700%. Yet when we do take a look at one of their close competitors, Monster Beverage, it is down over the last 12 months, 16%, and we do also see it trading right there towards its 52-week range. So we're going to find out, is this an undervalued company that we do need to take serious consideration into our own portfolio? We're going to take a look at the numbers, which do look very promising on the top line revenue as well as their bottom line net income. We'll also talk about their balance sheet, which does look very strong as well. Their total cash versus their total debt, a quick health check. And as always, we'll look at their free cash flow growth, their sales, ROICs, a lot of underlying metrics, whilst also discussing the insiders movement. We are seeing a lot of insider selling, and also see what are the institutions doing over the last 12 months as well as the last quarter. Now finally, we will get into the valuation of Monster, the intrinsic value, our own acceptable buy price given our investor margin of safety, and take a look to see what are Wall Street forecasting over the next 12 months. Now bear in mind, in today's episode, we will do a deeper dive into the DCF model, 3 different metrics, a low, medium and high, so you can understand where our valuation is coming from, and in fact you can also put a value to what you believe this company should be trading at. So first things first, it does get a double buy rating from Seeking Alpha and Wall Street, although we do know a hold from Quant. In terms of a forward P, well, 27.5, so it is valued higher than the S&P itself, which is 22.5, but as always, we will come on to the sector valuation for more relevancy. And whilst it is down 16% over the last 12 months, if you are a longer term shareholder, you would be up around 325%. So let's start off with the numbers of this company. Now, as always, we do want to see 3 to 7% as a baseline for the growth. Now, 2.5 billion reported in 2014. What is nice to note with this company, their growth has been very strong. Their more recent annual accounts, 7.1 billion. We are in fact seeing nearly 3 times growth over the top line. And what I'd quite like to see is that consistency over the longer term in terms of their top line revenue. And later on in this episode, we will also look at the percentage increases as well. In terms of the bottom line, what story can we see? Well, 483 million in 2014, 1.63 billion in 2023. So very similar to their top line. We are noticing increases over the course of the last 10 years, and we can see very similar to the top line that has grown nearly 3 times, so has their bottom line. So for me, consistency that we are seeing over the historical period is very good to note. We do love to see that on this channel. And then we move to their balance sheet, which is quite strong. 1.2 billion of cash and short-term investments in 2014, 3.6 billion in that latest quarterly report. So their cash, similar to their other metrics like the revenue and net income, have been growing, although a little bit more inconsistently over the longer term. And that 3.6 billion in reality means nothing in isolation, which is why we add this layer of review to compare it to their total debt numerically and directionally. 0 in 2014, 62 million in their latest quarterly report. Now, yes, it has been increasing over long term, but that is very, very minute in comparison to their total cash. And as we will come on later in the episode to see, they have a phenomenal balance sheet. It won't even take Monster 1 day to pay off all of their debt net of cash on hand. Now, what I quite like to see with companies, their historical performance against analyst targets as well as future projections. Now, this will give us confidence with those projections, but unfortunately what we do see, 2 out of the last 4 quarters, they have missed those targets, so a 50% track record where they have been either in line or have beaten analyst targets. And we can see, though, moving forwards, they are anticipating for 3 of the next 4 quarters double-digit growth to the earnings per share year on year. Now, if you do get confidence with their numbers, their projections, if they hit it in December 2025, that EPS 2.04 will give a forward P which will come down to around 24.06. Whether or not you do see them hitting this, again, information is there, so you can come to your own conclusion. Now we move on to some of their underlying metrics and gradings. The first one, valuation. Now they get a D-. One of the reasons here, as we can see, the PE 27.49 on a forward-looking non-GAAP basis is trading at a premium to the market, or sector median we should say, of 59%. And again, across several different other metrics, whether you use the price to book, the price to sales, the EV to sales, EBITDA, etc., you can see this company is trading at a significant premium. Now, what we would say is sometimes in cases when we do deep dives like today, you will be able to see that it is justified and warranted, but that is something we need to come to conclude today. So firstly, we can see growth grade. So look, year on year, in fact, let's start off with the grade of an A. Year on year, 13% is how much they increase their top line. Sector median 2.64. So we can already see where this valuation is coming from. A lot better revenue growth than the sector median historically. Moving forwards, whilst it is expected to lower, still double digit 11%, sector median 3.53. And what we also quite like to do, the earnings per share over the next 3 to 5 years, 13.24% increase year on year, sector median 8.17. So we can already start to see where this valuation is coming from, why it is higher than the sector median, but as always we will incorporate this into our valuation as well to understand whether or not the premium that is priced within Monster is warranted. Again, profitability A-, so we can already see the value with this company as opposed to others. 53% gross profit margin, sector median 35%, net income 23%, sector median 5.17%, and again their cash from operations 1.71 billion, others 821 million. So this is obviously a company that has some very strong growth metrics, profitability as well, but the question will come around the valuation. So conclusion for this part of the analysis, a double buy from these two analysts, a hold from Quant, D- on valuation, A on growth, and A- on profitability. Now, what we have to ask ourselves is how well has this company performed against others? Are there any key trends that we can spot? We have KDP, Keurig, Dr. Pepper, again, one we have reviewed on the channel, as well as others in the soft drinks and non-alcoholic beverages sector. What we can see over the last year, MNST is down 16%. It is the worst performing. Now we can see the sector as a whole is very inconsistent because we do have some that are negative as well, but we have 3 KDP, CCEP as well as Celsius that are up in fact fairly strongly. When we expand it to over the last 5 years, what we see here is that due to the fact that Celsius has returned a significantly strong return, it has blown the others out of the water. The others, as we can see, pretty much in line with each other, around 20 to 60%. Nothing great over a 5-year period. Then when we move to over the last 10 years, we can see the rest around the 300% for MNST as well as KDP. But again, we can see here Celsius up 30,000%. So what this tells us, if you look in isolation, Monster has performed very strongly at over 325%. Do bear in mind though that past performance does not mean that this is how they'll perform in the future. Could be a lot better, could be a lot worse, but as we can see, they are pretty much in the top 3 over the last 10 years. The second question you need to ask yourselves is this company going to outperform the S&P over the next 10 years and beyond? Has it also historically done? So over the last year, S&P up 25%, Monster down 16%. When we expand this to over the last 5 years, again, the S&P has outperformed. If you look at it from a 10-year perspective, while Monster has significantly outperformed the S&P. Again, this will be very subjective, come down to an investment thesis when you are looking long term, but as we do want to clarify here on this channel, if you don't see or you don't have a lot of confidence that a company will outperform the S&P, then you are most likely better off just investing in a low-cost ETF. Now, before we jump into some of more metrics, we just want to point out that in terms of insider ownership, it is fairly high, 7.8%. 6 insiders have sold over the last 12 months and 68 million worth of sales during this period. The largest one, in fact, in Q1 of 39 million, but we do also see 60 million worth of sales just in the last few weeks. And when we take a look to see who these insiders are, we can in fact see the CEO on the 11th of June did sell over 42,000 shares, and we can see the total transaction for over $2 million. Now, other insiders have also sold, as we can see here, but do remember this, in my personal opinion, isn't necessarily a bearish signal because they can sell for personal, financial, as well as many other reasons. But as always, transparency is there so you can come to your own conclusion. In terms of institutional ownership, well, 72%, 3.7 billion worth of sales over the last 12 months, near enough the same amount of buyers during the last 12-month period. But what we do want to highlight, over the last quarter, institutions have been selling more than they have been buying. Now, whatever institutions or insiders do, we always believe you should do your own due diligence, come to your own conclusions, but the information is part of our analysis, hence why we do incorporate this in today's episode. We also want to let you know we have released our latest free weekly article just now, 10 undervalued stocks. Now we're focusing on those with excellent balance sheets. If you want access to this completely free, do click on that pinned comment below. You will also get instant access to many other articles that we do have out here. So let's take a look at their metrics. First one, free cash flow. As always, we want to see increasing over the longer term consistently as well. It has nearly tripled over the longer term, but we do want to point out the inconsistency. We do anticipate over the next 12 months as well with Monster that this upward trend will continue. What I love to see from this company is not just a one-off, but over the last 10 years, 9 of those years, so in fact 2020 where we had COVID was the only one with single-digit growth. Other than that, we have seen double-digit numbers, 13% in the more recent year. Love to see that, and we can clearly see the increase in their top line as we did run through earlier today. Now, shares outstanding, as always, very important. We do want companies to return excess cash through those share buybacks. What we've seen is from 2014 to 2016, they went through a period where they did dilute your position issuing shares, although since then they have done some share buybacks, although very inconsistently, very trivially, and we can see marginal movement from the 2014 to 2023 numbers of shares outstanding. ROIC, as always, double digits, 10% or more to give us faith that management are able to effectively allocate their capital. Yes, we see a downward trend, but still in the mid-20s over the last few years is a very strong metric that a lot of investors would love to see. We then move on to the operating margin. Now, if you're a regular on this channel, you already know that we have spotted some minimal operating inefficiency as the margin has decreased over the longer term. Ideally, we want to see increasing revenue as well as increasing margins. Nonetheless, it is above the minimums of around 16% that we do want to see. Free cash flow margin, on the other hand, we want to see a minimum of 5%. Nice to note that pretty much over the longer term, they are more than 20%, which is very strong. And we do also see 20% on a trailing 12-month basis. Finally, we move on to the net debt to EBITDA. That is the earnings before interest, tax, depreciation, amortization. And what this shows us, it correlates to that balance sheet strength that we talked about earlier. 0 across the board, 0 into the next 12 months. These numbers represent the number of years it would take the company to pay off all of their debt net of cash on hand. So what this signals, a phenomenal balance sheet for Monster Corporation, something that we do love to see in companies that we want to purchase on this channel. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified videos as they drop. DCF model, now we have the free cash flow year on year. Average growth rate is skewed due to going from negative to positive a few of the years. And what we do note, 10% is what we're starting off with at the lower target. With that discount rate, we get the present value of future free cash flows and terminal value, add together with their cash, subtract total debt, get to the equity value, divide by those shares outstanding, and we can see, whilst we have an undervaluation signal, it is pretty much around the current trading price. So what we would say is essentially 2% upside. So if you believe over the longer term, 10% growth to the free cash flows, then we would say that right now Monster is trading at essentially its fair value. At 12%, for those that believe it should be higher, well, we can see an intrinsic value of $57, and that would give implied upside of 16%. Now, a lot of people may say that is still too conservative. Go for 14%, and at 14% we can see an intrinsic value of $65. Again, this would give implied upside of 33%. Now, bear in mind, this is very subjective. It will come down to where you see this company going into the future. And as always, you can grab a copy of this model by clicking on that pinned comment below, putting in your own numbers, whether it's for this company or others on your watch list or those in your portfolio. So in terms of growth rate, we're going to take the medium rate into the next slide, the intrinsic value, which in today's episode, no surprises, we are just using the DCF model, so it is arriving to $57.08. Now, with the current trading price of $49, we would go with a margin of safety to start off with, as always on the channel, 10%, which we execute if it meets the 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for Monster it is sufficient, well, it is a buy up to $51, and then we keep going till it's near the current trading price. Pretty much we would say it is trading at a 15% margin of safety, it is around 50 cents shy, so we would give them that. So 15% margin of safety for Monster. Whether or not you believe that is sufficient, it does look like a high quality company. A lot of signs of metrics that we would love to see. In fact, revenue increasing, bottom line increasing, very consistency, phenomenal balance sheet, and a lot of margins that we also like to see. Net debt to EBITDA 0 as well. In terms of Wall Street and their expectation, well, over the next 12 months, they see 24% upside. They have a price target of $61, and this could be one definitely to consider if you are looking to get into this space. Maybe you believe Celsius is trading at a premium right now, even after the drop, or maybe you just want to consider other companies that you haven't before. As always, if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, let us know your thoughts, and as always, we'll see you all on the next one.